and bonds. David Burrows, President and Chief Investment Strategist at Barometer Capital, is here taking your questions on North American large cap equities. We're off to Edmonton now for James. Hello, James.
Hello there. How are you people doing?
Good. How are you?
I'm doing fine.
Good.
Anyway, David, would it be a good time to buy a basket of an ETF, a ZUE or a ZSP? They're a BMO fund. It's an ETF. And is there growth in this? Or I know they have a low dividend.
Okay. So James, I'm not very familiar with those specific ETFs, but I believe that they are bundle of bank
ZUB, yep.
bank holdings. So if I were going to buy banks, I'd buy U.S. banks. We'd prefer those to Canadian banks, both from a currency perspective and the fact that growth is just a little bit stronger in the U.S. than it is in Canada, probably better opportunity for dividend growth. I would prefer to focus on one that is focused on regional banks, maybe something like KRE, which is the S&P Regional Bank ETF. I think that might look a little bit more attractive. Having said that, if you're going to be in the financial space, I think I would prefer to focus on a REIT ETF, like ICF, the Coleman and Steers REIT ETF. Or you might look at one of the investment management companies. We just think you might get a little bit more growth in either of those two.
Now, I'm going to do a little hedging of my own here because there's some dispute in the control room as to whether or not we heard James say ZUB or ZUE, which is the S&P 500 hedged to the Canadian dollar index ETF. So that's the S&P 500 basket. But I suppose whether it's the ZUB or the ZUE, these are hedged products. And so we're trying to factor out the Canadian U.S. dollar issue.
So if that's what you're looking at, if this is an S&P ETF, I would go unhedged because we do believe that the Canadian dollar is likely to continue to fall versus the U.S. dollar. In fact, it really isn't falling. It's just not rallying as quickly as the U.S. dollar is against the rest of the world's currencies. So in the portfolios that we manage, our equity portfolios are about 70% focused in the U.S. Our income portfolio is just about 60% focused in the U.S. We are unhedged on our currency exposure. With weak energy prices, weak commodities, and a slower growth in Canada, it's very possible Canadian dollar continues to weaken. I would continue to buy U.S. dollar denominated assets.
James, thanks for joining us from Edmonton. Louise in Hamilton, thank you for holding. Welcome to Market Call tonight.
Hi there.
Hi.
Hi, my question is on Google. I've owned Apple in the past. I'd like to get into the technology space. Would I be better in an ETF, or would Google give me the growth that you're talking about? Thank you, and I'm going to hang up.
Sure. So, Louise, I think that Google is a wonderful company. I think that the concern right now is that there is some competition in their core space in search and advertising. I think that you don't necessarily want to fade Google, but there may be better alternatives. I think at this point, if I was going to look for just exposure to technology, you might look at one of the broad-based technology ETFs that's going to give you exposure to software, semiconductors, security. You might look at something like the RYT, which is an equal weight technology ETF. You might look at XLK, again, which is a technology ETF, a technology spider. I think that might give you a better broad basket. There's lots of single stocks that you could focus on, but that might be a good way to do it.
RYT seems to expand beyond just the scope of your .com type operations. I've seen Corning's in there, as well as Accenture, Avago, Total Systems Service, et cetera. Seems quite broad-based.
You get exposure to services, you get exposure to software, semiconductors, hardware, across the gamut. And then listen, don't forget about Apple, because they are in the middle of a great product cycle. They're going to have their watch come. They're expanding into China. It is not an expensive stock. They got a great return on capital. I don't want to fade this one. This is the leader in the group. And if you have to own one, I'd probably buy Apple.
XLK is the ticker symbol for that alternative basket of stocks, Louise, and Apple is 16.5% of that. You mentioned the Apple Watch. I don't see a watch on your arm.
Well, my running watch came off before I came here today.
But
I will be in line to pick up an Apple Watch.
You're going to get one of those Apple Watches?
I'm a gadget guy. I've got to try them.
All right. Louise, thanks for the call from Hamilton. Let's squeeze in Kate in Toronto before the break. Hi, Kate.
Hi, gentlemen. Thanks for taking the call. A really great show.
Thank you.
I'm wondering, Mr. Burrows, what your thoughts are for healthcare generally and anything you could recommend here in the Canadian market. I'd appreciate it. Thanks a lot.
Anything in Canada?
Well, so first of all, on healthcare, so Kate, for those that watch regularly, this has been probably one of my 3 top picks have been a healthcare name for 2 years now. We very consistently have been focused on healthcare. It's the biggest industry in the U.S. It's highly domestically focused, and it's a sector that had been universally underowned in portfolios. So whether you're looking at pharmaceuticals or whether you're looking at biotech or whether you're looking at health maintenance organizations or devices, all of them are performing well very consistently in the market. I would focus on a U.S. name.
Let me guess, Activist?
So I would take a look at Activist. This is a pharmaceutical company that has roughly 50% of the revenue coming from generic drugs and roughly 50% from branded drugs. They have a wonderful management team that has been very, very efficient at creating value. They've recently purchased Allergan, which gives them a great opportunity to integrate that business and generate profitability from that business. It trades at a valuation that's similar to a generic company, but it does have the branded drugs, which probably make it a little more valuable. So I would take a look at that company as a great way to participate in the pharmaceutical space. And
its PEG ratio is 1, so there's growth in there. The PEG ratio, price earnings to growth, you want it to be about 1 or less.
That's right. And ultimately, they have a catalyst over the next 12 months, which is their opportunity to integrate Allergan.
Kate, thank you for joining us from Toronto. We're taking a brief break. As a reminder, you can also send your questions via Twitter. The show's handle is Market Call. For Mark Bunting, I'm Michael Hainsworth. We're back in a flash.